Alright, what's good YouTube? It's your boy Cookie FX here, and today I'm bringing you guys a the understanding market structure video. I've been getting this request a lot, as far as like I'm seeing that a lot of people are still struggling as far as like understanding market structure. Because if you guys know me, I absolutely love trading Fibonacci. Like Fibonacci, like the structure of Fibonacci is market structure. You're waiting for market structure break, pull back, you take it to the upside. Okay, so before we get started, like, some of you guys have to understand that market structure, it moves in Elliott waves. Okay, like it moves in a wave. So I'm gonna show this is gonna be a two-part series, because the first part I'm gonna basically explain how you can understand market structure, and then the second part I'm gonna give you guys live examples with candles, right, with the candlesticks, and then also with I'm also going to give you guys an indicator that I personally used in the past when I first was in my beginning stages to understand like how market structure, just to simply understand market structure and market structure break. Okay, so like I said, you guys have to understand that the market moves in waves. So I'm going to give you guys for bullish trends, bearish trends, and then I'm also going to give you guys the reversals. Okay, so like I said, it moves in Elliott wave. So I'm going to do the bullish trend first. Okay, so let's fix it up so it looks clean. Okay, alright, actually let me do that again, it looks nasty. Alright, so also let me say this as well, the market is not gonna draw it as perfectly as I'm doing it, if that makes sense. Like the market, it's gonna be a little sloppy, but you can still see that it's market structure break. So I'm gonna basically go through each point as far as like the Elliott wave, so that you guys can see and understand that, okay, this is how it moves in a bullish uptrend. Okay, so from point 0 to point 1, there's no structure being broken. Okay, so the leg from point 1 to point 4, basically, like I said, it's not gonna be perfect. I'm not gonna draw it perfectly, because you know the market doesn't draw it perfectly either. So so from point 0 to 1, actually, also let me say this before I get started, sorry. When the foundation of Fibs is retracements and extensions. Okay, so from point 0 to point 1, that's an extension. From point 1 to 2 is the retracement. From point 2 to 3 is the extension. From point 3 to 4 is the retracement, and from point 4 to 5 is the extension, and so on and so forth. Okay, that's why a lot of people, when you trade Fibs, it's you wait for structure to be broken, you wait for the pullback, it hits your golden zone, and then you take the extension. That's how Fibs is. That's how it works. So from point 0 to point 1, that's the structure. Let me actually put this full screen so you guys can see. From point 0 to point 1, that's structure to the upside, when it's creating higher highs and higher lows, when it's continuously making higher highs. So this is a high, point 1 is a high, higher high, point 0 is a higher low, point 2 is a higher low as well, point 3 is a higher high, point 4 is a higher low, and point 5 is a higher high. So when I break out the trend line, so from point 0 to point 1, that is it's going from a higher low to a higher high. From point 2, whoops, let me do it again. From point 1 to 2, it's going from higher high to higher low, because this low from point 0 to point 2 didn't come past point 0, so it's continuing on the uptrend. So this is when we expect the extension. So if it's creating higher lows, higher highs, we and once it pulls back, because it still hasn't broken the 0.1 structure, so once it goes from 0.1 to 0.2, we're from higher high to higher low, we're expecting it to create new higher highs if it's still on its bullish uptrend. Okay, so for the people who still don't understand where to draw your fib points, the most important one as far as the fib points is, in my personal opinion, is 1, 2, 3, 4. I say that because 0.0, come on trading view, 0.0 is just the start of the move. 0.5, from 0.4 to 0.5 is just where it hits, you'll take profit. So I mean, I guess you could include 0.5 as it being important as well, but for me personally, the most important ones are 0.1, 2, 3, and 4. So like I was saying, if it's creating higher highs and higher lows, it's on its bullish uptrend, and then it'll continue doing that as long as it doesn't pass the original point. So if if we're being logical, so this is 0.5 to 0.6, so obviously 0.6 didn't pass 0.4, so it's continuing on its bullish uptrend. Like I said, I'm not going to draw it perfectly, but that's the overall trend. Then from 0.6 to 0.7, it's extension, that's the extension from 0.5 to 0.6. So as far as where you draw, where do you see that the structure is being broken? It's from 0.1 to 0.4, that structure. Even 0.3 to 0.6, yeah, that's ugly. From 0.3 to 0.6, that high, if from 0.3 to 4, if it's, I'm sorry, from 0.4 to 5, if it's higher than 0.3, it's creating a new higher high. Okay, so for those who still do not understand that, that's where the structure is being broken to the upside. If it continues making that uptrend where it's creating higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, from 0.1 to 4, that's where the structure is being broken. 0.3 to 6, that's where the structure is being broken. From 5 to 8, that's where the structure is being broken. So now where do you start your fib from? Now before I show you where you start your Fibonacci from, just so you guys know, I'm gonna be creating probably like a maybe part 2 to probably like a part 3 series as far as like how I trade Fibonacci in my specific settings and everything, so stay tuned for that. But you start your fib from where the extension is happening and it's breaking structure. So if 0.0 is a higher low and 0.1 is a higher high, we're waiting for the pullback, which is the retracement. So we're waiting for the next higher low, which is 0.2. Basically from 0.2 to 0.3, the extension, it's breaking structure to the upside from 0.1. Excuse the noise on the outside, excuse the outside noise. It's breaking structure to the it's breaking structure to the upside, so it's breaking that higher high from 0.1 because it's creating a new higher high. Okay, so when we pull our Fibonacci, you start it from 0.2 to 0.3. Let me say that again, 0.2 to 0.3, because the extension is breaking structure. That's where it's breaking structure. Now 0.4, the reason why I said earlier that 0.4 is very important is because 0.4 is where the golden zone gets hit. So like I said, I'm not gonna explain my Fibonacci settings in this part, in part 1 or part 2 of understanding market structure. I'm gonna explain it for the Fibonacci series that I have, because like I said, a lot of people who know me more on a personal level really know that I really enjoy trading Fibonacci because it's so simple. You wait for it to break structure, pull back, you enter for the uptrend or for the downtrend. That's just how it is. So basically you start your fib from 0.2 to 0.3, and as you can see, it's rejecting off of our 38.2. This, like I said, I'm not gonna explain it, but from the 38.2, the 50%, or the 68, the 61.8%, that's where when the retracement starts from 0.3 to 0.4, that's these three zones right here, that's my golden zone. Okay, so you basically wait for it to from 0.2 to 0.3, you let it hit your TPs. Sometimes it might hit your TP1, TP2, and then it'll pull back to 0.4. That's why I say the market won't draw it out very perfectly. Okay, so like I said, in this case, we're literally continuing on a trend. So actually, let me take this off. Let me take the fib points off, and let me go back full screen. Also, with Fibonacci, since you're breaking structure to the upside, you can use market structure to help yourself identify like break and retest. Okay, so for example, from 0.1 to 0.4, what is that in a bullish uptrend? It once was a resistance from 0.0 to 0.1. We waited for it to create a higher low. From the extension from 0.2 to 0.3, from this low to this high, we wait for it to break structure. 0.1 and 0.4 is the structure. Well, really it's 0.1 because we still don't see 0.4, but 0.1 is the high that's being broken. So from the extension from 0.2 to 3, it's breaking this support. So that's why I say when you start your fib, start it from 0.2 to 0.3, because 0.4 is the pullback from the break and retest. So it's breaking structure to the upside. Now this resistance was once it's now a support, because we have to wait for it to pull back. That's why trading fibs is super like you have a higher probability if you use it with break and retest, just because of the fact that you're literally just waiting for it to break structure to the upside, wait for it to pull back to continue going up. Same thing from 0.6 to 0.8. It's the same thing. 0.5 is the once was a resistance. Once it pulls back downwards to actually hold on, I skipped a step. So 0.3 to 0.6 is the exact same thing. You start your fib. Let me actually delete this one. This is the exact same thing. If you're seeing it's on a major uptrend, continue with the trend. That's why they say the trend is your friend, and that's why I made the 200 EMA video. The 200 EMA helps you identify the overall trend without you having to sit down and calculate, okay, is it making higher highs, or is it making higher highs and higher lows, or is it making higher lows, lower highs and lower lows for a bearish trend. So basically what I'm saying is, for 0.3 to 0.4, from 0.4 to 0.5, it's the exact same thing. 0.4 to 5, like I said, I didn't draw it out perfectly, but 0.4 to 0.5 is the extension, and it's breaking structure to the upside from 0.3. Same exact situation here. 0.1 is the high, 0.3 is the high, 0.5 is the high, 0.7 is the high. Anytime it breaks these highs, it's continuing on its original trend. Okay, so it's the same thing for 0.6 to 0.7. It's breaking structure to the upside. As far as 0.5 is the higher trend. Is the higher high. 0.5 is where the structure is being broken. So it's like I just stated, 0.1, 0.3, 0.5, 0.7, 0.9, 0.11. That's where the structure is at. Okay, so that's it for a bullish trend. It's the exact same thing for a bearish trend. Even here, you just wait for it to break structure. That's why you'll see it when I make the when I post the Fibonacci sniper series, but you'll see that you have higher probability fibs when you trade them off break and retest, just because it's literally breaking structure to the upside. You wait for it to pull back the retest, you wait for the retest, which is hitting your golden zones, then you just take it to the upside. That's it. It's the same thing for a bearish trend. So let's go for a bearish trend. It's the exact same thing. It's creating lower highs, lower lows, lower highs, lower lows, lower highs. It's the exact same thing. It's on a bearish trend. You're from point 0 to point 1. Where's the structure? It's the exact same thing. The structure is point 1. Like I said, it's not going to be perfect, but the market will never draw it out perfectly. So for those people who trade like channels and like ascending triangles and stuff like that, you'll be able to see I don't trade like that, but you'll be able to see clearly where the Elliott wave points are. It's the exact same thing. Where's the structure right here? Where's the structure? It's breaking point 1. Then you wait for the pullback. You wait for the pullback from point 2 to point 3. That's where you from point 2 to point 3 is the break of structure to the downside. It's breaking structure of point 1. Okay, remember point 1 and point 1, 3, 5, 7, 9, 11. That's where the structure is. It's the exact same thing. And then that's where the structure is. And then for point 2, 4, 6, 8, 10, that's where you're waiting for the pullback. Okay, so let me take this Fibonacci off. It's the exact same thing for from point 3. That's the structure. It's the exact same thing. Let's draw it out from point 6. Just imagine if it says point 6, point 7, point 8, point 9, point 10. It's the exact same thing, guys. If you are also having trouble seeing market structure as far as like Elliott waves, go to the line charts, which I'll show you, which is gonna be shown in part 2. But this is the same thing. That's the structure. Let me go here a little bit. Let me shoot it down. That structure, guys, it's the exact same thing. You wait for it to create the lows. You wait for the pullback. Okay. Same thing with a bearish trend. It's creating lower lows, lower highs, 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 and it's just a continuation. Like I said, if you're having trouble seeing the continuation, go to my 200 EMA video. I clearly stated, if it's underneath, I'm gonna state it again. If it's underneath the candlesticks, like how it is here, it's on a bullish uptrend. If it's underneath lower, it's on a bearish trend. That's why for people who trade trend lines, it's the exact same thing. On top, bearish, underneath, bullish. The trend line. Focus on the trend line here. It's the exact same situation, guys. It's not that difficult. You just have to properly backtest. And you always start your fib points from point 2 to point 3. Point 4 is the pullback and where it's breaking point 1's structure. Okay, start it. Boom. So we're having rejections off the 38. You take the extension, TP 1, 2, 3 are smashed. Okay, so that's basically market structure, bearish and bullish. Continue to rewatch this video, because I'm also going to explain how you can use, not how you can use, but how does it look like when it's breaking its trend. So let's draw it out real quick. Okay, so let's do it for a bullish trend, because like I said, guys, it's the same thing for a bearish trend. Okay, so you have higher highs, higher lows, higher highs, higher lows, higher highs. Okay, like I said, this is a bullish trend. We're on a bullish uptrend. For those who trade trend lines, you guys know exactly what I mean. You're on a bullish uptrend, okay? We're having rejections, 50%, the 61 or the 38. You take it and it goes up, okay? Now, how do we know that it's breaking off of its original trend? When 0.5 is lower, I'm sorry, when 0.6 retraces lower than 0.4, we know it's breaking its original trend. So what do I mean by that? Now it's going, since it's creating higher lows, it's going to start creating lower lows to then continue to create lower highs. So what do I mean by that? It's gonna go down, it's gonna close past 0.4, and then it's gonna break out of its original trend. So now it's creating a downtrend. It's the exact same thing, guys. You know, like I said, it's not gonna be as perfect, but it's the exact same thing. So now when do you see that it's breaking? Where's the structure that's being broken for it to reverse, for like it's not reverse, but where it's breaking out of its trend? It's breaking 0.4. So 0.5 to 0.6, that's where it's breaking out of its trend. But also, let me also say this, you want to really wait for 0.6 to 0.7, just because it can do something like this. Okay, let me take this off. 0.6, it can break 0.4, but it can then continue on its original trend. So it's still following its original trend, if that makes sense. But say, if that's why I say wait for 6 to 7. Do not just think, okay, just because it broke 4, that it's gonna continue on a down. It's gonna continue on the downside. If you see that point, hold on, let me take this off. If you see that it's breaking 0.4, wait for 0.6 to 7. And if 7 to 8 breaks 6, then it's breaking out of its original trend. Okay, so what do I mean by that? If 0.4, if you see from 0.5 to 0.6, it's breaking 0.4 and it's creating lower highs, then it's continuing for a downtrend. If you see that it's creating, but if you see that from 0.5 to 6 and then from 6 to 7 it's creating higher highs, it wants to continue on its bullish trend. It's the same exact thing for a downtrend. Okay, so that's basically it. That's why I say when it's quote unquote breaking out of its trend, I would tell you, I would advise for you to wait from 0.5 to 6. See what 0.6 to 7 does. If it creates higher highs, it wants to continue on its original trend. If it's creating lower highs, it's basically indicating that it's gonna break out of its trend, but it's also gonna create lower lows now. So that's basically market structure. You know, you hear this example, you have bearish market structure. You have here in this example, you have bullish market structure, and then here you have breaking out of its trend market structure. Okay, so like I said, when it's breaking out of its trend, you want to wait for you want to wait to see what 0.6 and 0.7 does, just because of the fact that if it creates higher highs, it wants to continue on its original trend. If it creates lower highs, that means it's breaking. It's basically starting to break structure. Okay, like I said, excuse the outside noise. These people are so loud over here, but that's basically the basics of market structure. You have to understand market structure, especially if you want to start trading Fibonacci. Like, you have to understand how the market moves. Okay, it moves literally in Elliott waves, and not only also for Fibonacci, but just as far as like market direction as well. Like, if you don't understand the direction that the market is moving in, you're gonna counter trend and then you're gonna get stopped out. Sometimes you can counter trend, but it's like I said, it's like they say the trend is your friend. Like if you can see that it's on a clear uptrend, why would you look for sells? Like, if that makes sense. If you can see that it's on a clear downtrend, why would you look for buys? You know what I mean? Now, as far as with it breaking its original trend, then that's the only way. That's the only time I recommend for you to trade, for you to counter trend. When it's breaking its original trend and you can see that from 0.6 to 0.7, it's, you know, it's breaking its trend. That's the only time I would really recommend for you to counter trend. But other than that, I don't really recommend counter trending like that, especially when you're trading fibs. Because say you go from 0.3 to from 0.2 to 3 on a bullish trend, but then say if it breaks its structure, you're gonna basically go from 0.5 to 6. You're gonna go from 0.5 to 6, and then from 7 to 8. You get what I'm saying? So it's like you can counter trend that way, because you could take the buy, wait for it to break its original trend, wait for the retracement, and go and take it to the downside or to the upside, like whichever direction it's breaking its original structure. But with that being said, I hope you guys enjoyed this video. I hope you guys learned something. Please watch this video over and over and over again. It will help you, especially like just because these are the basics. These are just the overall basics of trading. Market structure is like one of the most important things, other than like risk management and psychology and stuff like that. You have to understand how the market is moving. But with that being said, I hope you guys enjoy something. I hope you guys enjoy something. I hope you guys enjoyed this video. With that being said, I'm out. Peace and love. I'm gonna be bringing part 2 as well, so stay tuned for that. I'm out.